There is a dollar amount, a specific number, that the IRS and the federal government have been watching more closely than any other number in American banking since 2024. It is not $10,000. It is not $9,500. It is $15,000. And if you are a retiree, a homeowner over 60, or anyone who has moved a meaningful amount of your own money in the last 18 months, you need to stop what you are doing and watch this entire video. Because here is what nobody is telling you. The $10,000 bank reporting rule that most Americans have heard about, the one that has been in place since 1970, that rule did not disappear. It got worse. It got broader. And in 2026, the federal government quietly expanded the surveillance net around it in 5 specific ways that are already catching ordinary retirees completely off guard. People who did nothing wrong. People who were just moving their own money. People just like you. I am David Graves. I am an enrolled agent, which means I am federally licensed to represent taxpayers directly in front of the IRS. And what I am about to show you in the next 25 minutes is the same information I walk my private clients through before they make any major financial move in retirement. Your bank will never tell you this. The IRS certainly will not. But after today, you will know exactly what the new $15,000 threshold means, who it affects, and, most importantly, the 4 specific moves you can make this week to make sure you are never on the wrong side of it. Stay with me. This one is critical. I want to start with a story, because I could give you numbers and legal code sections all day, and I will, but nothing explains why this matters faster than what happened to a client of mine last fall. I am going to call him Raymond. Raymond is 73 years old. He spent 31 years as a civil engineer for the state of Michigan. He has a pension. He has a paid-off home in Grand Rapids. He has a savings account at the same credit union he has used since 1987. 37 years at the same institution. Last September, Raymond's wife Dorothy was diagnosed with a serious joint condition. The surgery was not fully covered by Medicare. Out of pocket, after insurance, Raymond was looking at $1,400 to $800. He had the money. He had been saving his entire life for exactly this kind of moment. So Raymond walked into his credit union on a Wednesday morning, asked for a cashier's check made out to the surgical center, and handed the teller his withdrawal slip. The teller looked at the screen. The teller asked Raymond to have a seat. A few minutes later, a branch manager came out, asked Raymond to step into a private office, and began asking him questions. Why did he need the money? Had anyone contacted him recently asking him to transfer funds? Had he met anyone online? Was he being pressured by anyone? Raymond, a 73-year-old civil engineer who spent 3 decades building roads and bridges for the state of Michigan, was being interrogated by his own credit union about paying for his wife's surgery. The manager told him the withdrawal was subject to a compliance review. It would take 48 hours. Raymond had to call the surgical center and push the procedure back by 2 days. Dorothy waited in pain for 2 more days because her husband tried to withdraw $14,800 of his own money. When the check finally cleared, Raymond thought it was over. It was not. 3 weeks later, he received a letter. A suspicious activity report had been filed on his withdrawal with the Financial Crimes Enforcement Network, a federal agency most Americans have never heard of. That report now sits in a federal database, cross-referenced against every future financial transaction Raymond and Dorothy ever make for the next 5 years. Raymond did nothing wrong. He is a retired engineer who needed to pay for his wife's medical care. And that is exactly what the new rules are doing to ordinary American retirees every single day. Right now, quietly, without a single word of warning. And the reason it happened to Raymond, the single thing that set it all in motion, was that his withdrawal landed just under a specific new threshold the banks are now required to flag. That threshold is $15,000. What the $10,000 rule actually is, most people have heard of the $10,000 bank reporting rule. Very few actually understand what it does. Under the Bank Secrecy Act of 1970, every financial institution in the United States, every bank, every credit union, every savings and loan, is required by federal law to file what is called a currency transaction report anytime a customer makes a cash transaction that exceeds $10,000 in a single business day. That report, filed on FinCEN Form 104, goes directly to the Financial Crimes Enforcement Network. That is a bureau inside the U.S. Treasury Department, not the IRS. The Treasury. You do not fill out a form. You do not sign anything. You will not be told it happened. The bank has 15 days to file it electronically and is required to keep records for 5 years. This happens millions of times a year. The vast majority of those reports go nowhere. No call, no knock on the door, no frozen account. A currency transaction report is not an accusation. It is not an audit. It is not a red flag. It is routine automatic paperwork. But here is where it gets dangerous. And here is where the new $15,000 number enters the picture. Why $15,000 is the new line to watch in 2026. In 2024, FinCEN issued updated guidance to financial institutions across the country on how they are expected to monitor senior customer accounts specifically. This guidance, combined with expanded elder financial protection laws now active in more than 40 states, created a new practical trigger point for human review inside most banks. That trigger point has settled around $15,000. Here is what that means in plain language. The $10,000 legal threshold still exists. That has not changed. But because of inflation, because of upgraded bank compliance software, and because of the new senior protection laws, most banks have now calibrated their internal review systems to flag transactions in the $12,000 to $17,000 range for a secondary human review, even when the transaction itself is completely legal. Why $15,000 specifically? Because in 2026, $15,000 is the most common transaction size for the things ordinary retirees actually do with their money. A used car purchase. The average private sale price is now $14,200 to $16,800. A partial home repair or kitchen renovation, average out-of-pocket is $12,000 to $18,000. A medical procedure not fully covered by Medicare, the average out-of-pocket gap is $11,000 to $16,000. A gift to an adult child for a down payment, the average first-time homebuyer gift from a parent is $14,000 to $20,000. A lump sum required minimum distribution, the median annual RMD for Americans 73 and older is now over $15,000. In 1970, when this law was written, $10,000 was more than most Americans made in a full year. A gallon of gas was 36 cents. A median new home cost $23,000. The $10,000 threshold was designed to catch drug traffickers and money launderers. In 2026, that same $10,000, adjusted for 55 years of cumulative inflation, would be equivalent to roughly $82,000 in today's dollars. Instead, Congress has never moved the threshold, not once in 55 years. So the rule that used to catch criminals now catches your grandmother paying for a knee replacement. The law has not changed. The economy has. And the gap between them is now wide enough to swallow a retiree's life savings. The hidden rule that is far more dangerous. Now, most people think the currency transaction report is the only thing they need to worry about. It is not. There is a second type of report called a suspicious activity report, and this one has no dollar threshold at all. A suspicious activity report can be filed on a transaction of any size, $500, $200, $50. There is no minimum. The bank's internal compliance software decides whether to flag you based entirely on whether your transaction fits a pattern the algorithm identifies as unusual. And here is what makes this especially dangerous for retirees. Federal law prohibits the bank from telling you that a suspicious activity report has been filed on your account. It is a crime for a bank employee to inform you. You could be in that federal database right now and have absolutely no idea. So what does the software look for? I want to give you 6 specific behaviors that are triggering suspicious activity reports on senior accounts across the country in 2026. Listen carefully, because most retirees have done at least 3 of these in the last year without ever realizing it. Behavior 1. Any deposit or withdrawal that breaks your personal historical pattern. If you have averaged $400 a week for a decade and you walk in and ask for $8,000, That deviation alone gets flagged. The software does not know why you need the money. It does not care. It flags the break in your pattern. Behavior 2. Multiple deposits that when added together would have crossed the $10,000 line. 2 $5,500 deposits 3 days apart. 3 $4,000 deposits over 2 weeks. 4 $3,000 deposits over a month. The software now looks back across a rolling window of up to 90 days. This pattern has a name under federal law. It is called structuring, and under Title 31, United States Code Section 5324. Structuring is a federal felony carrying up to 5 years in federal prison, even if every dollar of the money is completely legal. Behavior 3. The first wire transfer from an account that has never sent one before. The algorithm treats first wires as high-risk events regardless of the amount because the first wire is the most common method used to move money out of an account being exploited. Behavior 4. Round numbers just under the reporting threshold. A deposit of exactly $9,000. A withdrawal of exactly $8,500. The software is specifically trained to look for these because they are the signature pattern of someone trying to avoid detection. Here is the painful irony. The very act of trying to be careful is what gets you flagged. Behavior 5. A large cash deposit with no documented source. If you sell your car privately for $14,000 and deposit the cash without any paperwork, the bank sees an unexplained large cash event on a senior account. That is a flag every single time. Behavior 6. A third-party deposit. If your son, your daughter, or anyone else walks into your branch and deposits cash into your account on your behalf, the bank logs it as a third-party deposit. Third-party deposits above a few $1,000s are reviewed almost every time, regardless of who made them or why. Stack those 6 behaviors on top of the new $15,000 threshold sensitivity, and you can see why the answer is not to try to outsmart the system. The answer is to understand the system and move with it, not against it. Let me walk you through 5 specific situations. These are the exact moments where retirees make the decision that costs them everything. And for each one, I am going to tell you exactly what to do instead. Scenario 1. Selling a vehicle or large personal asset for cash. You sell your truck privately for $15,500. The buyer pays cash. You take the envelope to the bank. What most people do wrong. They deposit $7,000, wait a few days, deposit the rest. That is structuring. That is a federal felony, even though the money is completely yours and completely legal. What to do instead? Deposit the full $15,500 in one single transaction. Bring a copy of the bill of sale, the buyer's name, your name, the date, the amount, and both signatures. When the teller asks where the money came from, you say 3 words, "I sold my truck." You hand them the bill of sale. A currency transaction report gets filed automatically. Nobody contacts you. Your life continues. There is nothing to investigate because there is nothing wrong. Scenario 2. Receiving a large cash gift from your children. Your son and daughter-in-law give you $16,000 to help cover a medical procedure. Your neighbor told you to break it up into smaller deposits to keep it under the limit. Your neighbor is giving you advice that could result in a federal felony charge. Here is the truth about gift tax law in 2026. A single person can give up to $19,000 per recipient per year with 0 reporting requirement. Even above that amount, the person who gives the money files a gift tax return, not you. You receive a gift. You owe nothing. You file nothing. Deposit the full $16,000 in one transaction. Ask your son to write a 1-paragraph gift letter. His name, your name, the amount, the date, and 1 sentence stating it is a gift with no expectation of repayment. Keep that letter in a folder. That letter is your complete legal protection. Scenario 3. Moving your own money between accounts. You are consolidating accounts after your spouse passed. You decide to move $23,000 over several weeks in smaller amounts because you do not want to deal with a large transfer while you are grieving. I understand that instinct completely. But the bank's software does not know you just lost your husband. It does not know you spent your whole life saving that money. It sees repeated deposits under $10,000. It files a suspicious activity report. Your name goes into a federal database during the worst period of your life. The right move is to transfer the full amount in one single transaction. Keep the bank statements from both accounts. Keep the transfer confirmation. One move, clean records, nothing for the software to flag. Scenario 4. Paying a contractor for homework. Your roof needs replacing. The job costs $16,000. You pay the contractor with a cashier's check or cash from your savings. That contractor is now required by federal law to file IRS Form 8300, identifying you, your Social Security number, your address, and the nature of the work. If you break that payment into two $8,000 installments for the same job, the contractor is still required to aggregate them and file. And you have created a structuring pattern on top of it. The safest move is to wire directly to the contractor when they accept it. Most prefer it because it eliminates their own cash handling costs. If not, one cashier's check for the full amount with a signed contract showing the scope of work. The contract is your documentation. The paperwork is your protection. Scenario 5. A Social Security or pension lump sum. If you delayed filing for Social Security, you may be entitled to a retroactive lump sum covering up to 6 months of back benefits. That payment can easily exceed $15,000. When it lands in your account, a currency transaction report gets filed automatically. That is completely fine. The Social Security Administration has records of every payment. Your bank has the deposit on record. Everything matches. There is nothing to explain. What trips people up is what happens next. They panic when they see a large government deposit and start moving the money around in smaller amounts to different accounts. That behavior, even with Social Security money, triggers a suspicious activity report. Leave it exactly where it lands. The documentation exists automatically. Do not create a problem where there is not one. All right, you now know more about this system than the overwhelming majority of retirees in this country. But that knowledge means nothing unless you act on it. Here are 4 specific moves I want you to make this week, not next month, this week. Protection. Move 1. Pre-notify your bank before every large transaction. Before any deposit, withdrawal, or transfer of $8,000 or more, call your branch manager directly. Tell them what the transaction is and why. Ask them to make a note in your customer account file before the transaction happens. When the transaction hits the compliance software, that note is right there waiting for the reviewer. The 72-hour freeze almost never happens when you have pre-notified. The currency transaction report over $10,000 still gets filed automatically. That is not something anyone can stop. But your money actually moves when you need it to. This is free. This takes 5 minutes. This is the single highest leverage move in this entire video, and almost no retiree knows it exists. Protection move 2. Build your transaction folder. Today, get a physical folder or a digital one, whatever you are comfortable with, and label it Transaction Records. Every time you make a deposit, withdrawal, or transfer over $5,000, put 4 things in that folder. 1. A 1-sentence note describing the source. Write it the same day. Something like, received $15,500 from the private sale of my 2018 Ford F-150 to James Callahan on April 3, 2026. Date it. That is your record. 2. Any supporting documents. A bill of sale, a gift letter, an estate settlement document, a Social Security award letter. Whatever proves where the money came from. 3. Your bank statement showing the deposit. 4. Any transfer confirmation if money moved between accounts. You will probably never need this folder. But if you do, if someone questions a deposit from 3 years ago, you will be deeply grateful it took you 5 minutes to put it together. That folder is your complete legal defense. Protection, move. 3. Request a senior banking authorization. Most banks do not advertise this option. You have to ask for it specifically. A senior banking authorization is a formal written agreement between you and your bank that does 3 things. It identifies in advance the types of transactions that are consistent with your normal financial life. It designates a trusted contact, a family member, a close friend, that the bank can reach before delaying any transaction. And it pre-authorizes common transaction categories like medical expenses, car purchases, family gifts, and home improvements as pre-cleared under the bank's Elder Protection Review process. When that authorization is in place, the compliance software checks your pre-authorized categories before it ever triggers the freeze. A transaction that would have been held for 72 hours under the default system clears the same day under the authorization. Ask for the bank's Senior Customer Services Department or Wealth Management Team. The form itself is short. The protection it gives you is significant. Protection Move 4. Move excess cash out of your primary checking account. Every dollar above your 3 to 6 months of living expenses sitting in a regular checking account is being watched by compliance software, eroded by inflation, and used by the bank to make money you will never see. The practical guideline most financial planners give their own clients: keep no more than $20,000 to $25,000 in your primary checking account. Move the excess to a high-yield savings account at an online institution. Ali, Marcus, by Goldman Sachs. Discover Capital One 360, where you can currently earn between 3.5% and 4.5%, fully FDIC insured, with no fees and full liquidity within 1 to 3 business days. The money is still completely yours. You can move it back to your checking account whenever you need it. But it is no longer sitting in a watched retail account, where every large transaction triggers pattern recognition software. Raymond, the client I told you about at the beginning of this video, eventually did exactly this. He kept $12,000 in his original credit union account and moved the rest into an online high-yield savings account and a short-term treasury bill ladder. The next time he needed to make a large payment for Dorothy's care, the transfer happened in a single afternoon. No manager interview, no 48-hour hold, no suspicious activity report filed. He told me later that the biggest surprise was how simple it was. The new account was easier to open than his original one. The interest started accruing the same day, and the peace of mind, his words, not mine, was something nobody warned him about. Once the money was out of the watched account, it stopped being watched. That is the whole game. Let me close with the most important thing in this entire video. The $15,000 sensitivity threshold is not going away. The Bank Secrecy Act is not being simplified. The pattern recognition software inside your bank is not getting more senior-friendly. Every single year that passes, the gap between that frozen $10,000 legal threshold and the real cost of everyday life and retirement gets wider. The retiree who does nothing, who does not pre-notify the bank, does not build the documentation folder, does not request the senior banking authorization, and does not move excess cash out of their watched primary account, is going to be the retiree who gets frozen, flagged, and reported at exactly the worst possible moment, the moment they need their money most. That is not a prediction. That is what is happening right now to tens of thousands of American retirees. Quietly, without news coverage, without any senator giving a speech about it, transaction by transaction, account by account, family by family. You do not have to be one of those families. You have the information now. You have the 4 protection moves. The only thing left is to act on them before the next time you need to move a meaningful amount of your own money. If this video was helpful, and I believe it was, hit the like button right now. That one click is what tells the YouTube algorithm to show this to more retirees who need to hear it before something like "What happened to Raymond" happens to them. Subscribe to this channel if you have not already, because next week I am going to walk you through the 5 specific accounts that financial planners actually use for their own retirement savings. Accounts that pay 3 to 5 times more than a standard checking account, keep your money fully FDIC insured, and remove you from the suspicious activity scoring system entirely. And before you close this video, send it to one person, one parent, one sibling, one neighbor, one friend who is over 60 and still keeps most of their savings in a single bank account. 25 minutes of their time right now could save them a suspicious activity report they will never even know was filed against them. I am David Graves. I will see you in the next video.